Today's episode is brought to you by Mazars.
SoundCartel.
From SoundCartel, I'm Nicole Goodman, and this is Business Essentials Daily. A new financial year often heralds changes to the tax rules, and this year they apply to work-related car expenses, super payments, Division 7A loans, and a lot more. To walk us through the most important changes is Deepra Sen, Associate Director at Mazars, who starts with the work-from-home rules. He's talking to Chris Ashmore.
The most significant change for the work-from-home deduction rules from 2023 as compared to 2022 is the end of the shortcut method of 80 cents per hour, which is now replaced by the new revised fixed rate method of 67 cents per hour. Since the 1st of March 2023, taxpayers choosing to use this approach must keep a record of the total number of actual hours worked from home, and a representative record of the total number of hours working from home will no longer be acceptable. For the period of 1st of July 2022 to 28th of February 2023, a representative record will be accepted by the ATO.
What's the change for claiming work-related car expenses?
So the change for claiming work-related car expense relates to the rate per kilometre, which has now increased from 78 cents per kilometre for the 2022-23 financial year to 85 cents per kilometre for the current financial year. This may also affect employer reimbursements or employees' car expenses as well as employees' claims in their 2024 income tax return.
Can you tell me about the end of loss carry back tax offset?
This temporary COVID-19 measure has now ended on 30th of June 2023. It was where any corporate tax entity with an aggregated turnover of less than 5 billion that made a tax loss in 2022 and 23 can choose to carry that loss back against tax profits made between 2018-19 to the 2022 financial year.
And what's next for full expensing?
So temporary full expensing in its previous form has now come to an end on 30th of June 2023. So claims for the cost of eligible depreciating assets by eligible entities can continue to be made in the 2023 tax returns, but a different set of rules apply to assets first used or installed ready for use on or after 1st of July 2023. Generally, documentation such as invoices, contracts, bank statements, and general ledgers are evidence only of when a contract was signed, deposit paid, or an invoice for the purchase of the asset was issued. So none of these are sufficient to determine the date on which the business's assets were first used or installed ready for use, which will then start with a conversation with the business owners. If the asset is first used or installed ready for use on or after 1st of July 23, the asset will be subject to the rules that apply this financial year. For small business entities that choose to use the simplified depreciation rules, the following will apply. Less than $20,000 GST exclusive value must be fully written off under the yet-to-be legislated increase in the instant asset write-off threshold, which has decreased to $20,000 from the 1st of July 2023 to 30th of June 2024. Assets that cost more than $20,000 will need to be allocated to a general small business pool and depreciated according to the pooling rules. Larger businesses with aggregated turnover of $10 million or more must depreciate their assets under the normal depreciation rules with a full deduction available for assets with a GST inclusive value of $100.
Now, I understand there's a technology boost for small businesses.
That's correct. And this came in very recently when it was legislated in June of 2023, which basically states small businesses with an aggregated annual turnover of less than $50 million can deduct an additional 20% of the expenditure incurred for the purposes of business digital operations or digitizing its operations on business expenses and depreciating assets, such as portable payment devices, cybersecurity systems, or subscriptions to cloud-based services. This measure will apply from the 29th of March 2022 to 30th of June 2023, encompassing 2 financial years. An entity can claim the boost for expenditure on a depreciating asset only if the asset is first used or installed ready for use by 30 June 2023. An annual cap applies so that expenditure up to $100,000 is eligible for the bonus 20% deduction, with the bonus deduction being capped at $20,000 per year. So businesses will be able to claim a maximum bonus deduction of $40,000 over a 2-year period. Businesses can continue to deduct expenditure over $100,000 under existing law.
Well, that's terrific. And what's the small business skills and training boost?
So that's another measure which has now come in and legislated in June of 2023, where small businesses with an aggregated annual turnover of less than $50 million will be able to deduct an additional 20% of expenditure that is incurred for the provision of eligible external training courses to their employees by registered providers in Australia. Businesses may continue to deduct expenditure that is ineligible for the bonus deduction in accordance with the existing tax laws. This measure will apply from the 29th of March 2022 to 30th of June 2024 over 3 financial years. As a criteria, the expenditure must be for the provision of training to employees of the business, either in person or in Australia or online, charged directly or indirectly by a registered external training provider that is not the business owner or an associate of the employer and is already deductible to the business under taxation law. The following are ineligible for a claim under this measure, which is training of non-employee business owners such as sole traders, partners in a partnership or independent contractors, costs added on an invoice by an intermediary on top of the cost of training such as commissions or fees as they're not charged directly or indirectly by the registered training provider.
Now, Division 7A loans, I understand there are significant changes there.
With the changes for Division 7A, the most significant one is the sizable jump in the benchmark interest rate from 4.77% for 2022-23 to 8.27% for 2023-24. Loans made by private companies to shareholders or their associates need to be fully repaid or placed on complying loan terms before the company's lodgement day for the 2023 tax return. If the choice is made to manage such a loan or a complying loan, the first minimum yearly repayment is due by 30th of June 2024.
Now, super, that's gone up. Remind us, Deepra, what's the rate gone up to?
So the rate has gone up from the 1st of July 2023 from 10.5% to 11% on all payments of salaries and wages and other ordinary times earnings.
And can you tell us about the increase in the general transfer balance cap?
The General Transfer Balance Cap, or the TBC, has increased to $1.9 million from the 1st of July 2023, which is an increase from the 1.7 million figure, which was the cap for 2021-22 and 2022-23. While this means more earnings on superannuation balances in retirement phase will be treated as tax-free, calculating the proportionate indexation of an individual's personal transfer balance cap becomes increasingly complex as the general transfer balance cap continues to increase. The ATO will calculate each individual taxpayer's personal transfer balance cap, which will fall somewhere between the 1.6 million and the 1.9 million figure mark, depending on when the individual commenced their income stream and the highest ever balance in the individual's transfer balance account. After indexation is applied, an individual who had a transfer balance account prior to indexation will be able to see their personal transfer balance cap on the ATO online services via MyGov or through online services for agents. The other aspect of the indexation of the general transfer balance cap is also the amount of non-concessional contributions that an individual can make and the bring forward rule and whether they can extend the bring forward period to 2 or 3 years.
And what are the changes to the minimum annual income stream payments?
So the minimum income stream payments have now reverted to their full amounts after halving of the minimum amount that must be paid for certain superannuation pensions and annuities due to the COVID-19 pandemic from 2019-20 to 2022-23. The percentage has now returned to 100%.
What happens if there's a failure to make the minimum payment?
It causes a few things for the superannuation fund in question. Namely, it causes the income stream to cease for income tax purposes, treats the fund as not having paid an income stream from the start of the income year, treats any further payments made as lump sum payments during the year, prevents the fund from treating any income as exempt current pension income, so the fund loses its tax exemption on the earnings for that year. It'll be important for superannuation funds and SMSF members primarily to be aware of this and meet the rates for 2023-24 to ensure no adverse tax outcomes arise.
That's a lot of detail you've provided today, all very good. But for anyone listening who perhaps needs more information or advice, what should they do?
So with income tax and financial advice, it's advisable that taxpayers seek their own independent tax advice before making any decisions, because while legislation is important, it is generic in nature, and each individual needs to assess their situation on a case-by-case basis to ensure that they get the best tax outcome within the legislation.
That was Deepra Sen, Associate Director at Mazars. This episode of Business Essentials Daily is produced by the team at SoundCartel. Thanks for listening. I'm Nicole Goodman. We'll bring you more Be Daily tomorrow. Follow at BE Daily Podcast across social media and head to bedaily.com.au for more from the Business Essentials Daily podcast. SoundCartel. This episode was brought to you by Mazars. To find out more, visit mazars.com.au. That's mazars.com.au.